5 things you may not know about the financial assessment. Welcome to the Industry Leader Update, brought to you by Reverse Focus. 2 weeks ago today, we hosted a national webinar on the financial assessment with over 800 participants nationwide. Now, since that time, the proverbial dust has begun to settle, allowing us to absorb more details for the new way of doing business. That said, there are 5 key facets of the financial assessment that may be overlooked or misunderstood. Number 1, credit scores. One could reasonably conclude that anytime a lender is checking a credit report, the applicant's credit score is a key factor in determining their eligibility. Fortunately, unlike traditional mortgages where the applicant's credit score not only determines eligibility, but the interest rate charged, the HECM program has no such consideration. The credit report is solely for examining a borrower's history of paying obligations in a timely manner, thus indicating their willingness to meet the financial obligations of a reverse mortgage. Number 2, non-HECM liens. Recently uncovered, this is the requirement that non-HECM liens, where the borrower received $500 or more, must be seasoned for at least 12 months. Your most typical non-HECM lien will be recently acquired and utilized home equity lines of credit. Remember, only non-HECM liens where the borrower received $500 or more require seasoning. 3, cash and savings. A borrower's abundance or lack of savings or a retirement nest egg is not a requirement nor a determining factor in itself. However, cash and retirement accounts can help increase the applicant's overall available income as the assessment considers the potential liquidation and use of these funds over the applicant's life expectancy, possibly helping them meet the residual income guidelines. Number 4, partially funded LESA or lifetime expectancy set-aside account. In some instances, applicants may have a credit history which shows a willingness to meet their financial obligations, but may lack the capacity to do so financially. Now, this is where a partially funded LESA may be required. In such cases, the borrower's residual monthly income after expenses may fall below the mandated minimums. For these borrowers, the shortfall in monthly residual income is calculated along with their life expectancy from the TALC to arrive at a reduced set-aside amount. The borrower would receive semi-annual payments from this account to pay both property taxes and homeowners insurance premiums. And number 5, existing mortgage payoff. The godsend for the HECM program today and in the future is the payoff of an existing mortgage, thus eliminating monthly mortgage payments. Now, this improvement in monthly cash flow is actually considered in the financial assessment calculations and in many cases will help those with lower incomes, allowing them to meet the residual income guidelines. Now, what overlooked aspects of the financial assessment would you add to this list? Leave your comments in the comment section below and have a great week.